For most of the 20th century, capitalism followed a simple promise. If you worked hard, improved your skills, and stayed productive, your living standards would rise alongside the economy. Wages grew with productivity, and economic growth translated into broader prosperity. Today, that promise feels broken. Asset owners grow wealthier while workers struggle to keep up, even as economies expand and markets hit record highs. This isn't just inequality or bad luck, and it isn't the result of individual failure. It reflects a deeper structural shift in how modern capitalism distributes rewards. Over time, the system moved away from compensating labor for productive contribution and toward rewarding ownership of assets that benefit from financial expansion, policy support, and rising prices. To understand why work matters less and assets matter more, we need to trace how capitalism itself quietly changed, and why this shift now defines economic outcomes across nearly every advanced economy. Capitalism did not always reward assets more than work, and for much of the post-war period, the opposite was true. From the 1940s through the early 1970s, economic growth was driven primarily by productivity gains, industrial expansion, and rising real wages, which meant that labor captured a meaningful share of economic progress. Strong unions, regulated financial markets, and policy frameworks designed around full employment ensured that productivity translated into income growth for workers, rather than simply higher returns for capital. Asset prices rose, but they did not dominate economic outcomes, because finance played a supporting role rather than a central one. This balance began to change when growth slowed, inflation rose, and policymakers searched for new ways to stabilize economies without triggering political backlash. As financial markets were liberalized and monetary systems became more flexible, capital gained new pathways to generate returns independent of productive output. Asset prices increasingly responded to credit conditions, policy decisions, and financial flows rather than improvements in real economic capacity. Over time, this shift altered incentives throughout the system, reducing the importance of wage growth while elevating the value of ownership. Work still mattered, but it no longer determined outcomes the way it once did, as returns became increasingly detached from productive contribution and tied instead to access to capital and appreciating assets. If this shift did not happen naturally, the next question is, what specific forces pushed capitalism away from rewarding work and toward rewarding ownership instead? One of the most decisive shifts that caused capitalism to reward assets over work came from changes in monetary and financial policy beginning in the 1970s. As inflation surged and productivity growth slowed, governments and central banks redefined their priorities, moving away from full employment and wage growth toward price stability, capital mobility, and financial market confidence. This transition reshaped incentives across the entire economy. Policies that once strengthened labor, such as strong union protections, wage indexation, and industrial policy, were weakened or dismantled, while financial deregulation expanded the influence of markets in allocating capital. Interest rates became a primary policy tool, and controlling inflation increasingly took precedence over maintaining tight labor markets. These choices did not explicitly aim to disadvantage workers, but they altered how value was created and rewarded. Lower and more flexible interest rates raised the present value of assets, boosting stocks, bonds, and real estate, while wages remained anchored to slower-moving productivity trends. As credit expanded, asset prices responded immediately, creating wealth effects for owners that far outpaced income growth for workers. Financial markets came to dominate economic signaling, meaning success was measured through asset performance rather than employment quality or wage growth. Over time, this policy framework normalized a system where capital appreciation substituted for broad-based income gains, making ownership more important than contribution. Once asset stability became synonymous with economic stability, governments became increasingly reluctant to allow asset prices to fall, reinforcing a structure where returns to ownership were protected, while labor absorbed adjustment costs through stagnating wages and insecurity. With policy now favoring capital over labor, the next force that deepened this imbalance was the globalization of production and finance. Globalization intensified the shift toward asset-based rewards by breaking the historical link between domestic labor and economic outcomes. As trade barriers fell and supply chains stretched across borders, companies gained access to cheaper labor pools and global consumer markets, reducing their dependence on domestic workers for profitability. While globalization lowered production costs and increased efficiency, it also weakened workers' bargaining power in advanced economies, as jobs became more mobile while labor remained geographically fixed. Capital, by contrast, became highly flexible, able to move instantly toward jurisdictions offering higher returns, lower taxes, or favorable regulations. Financial markets reflected this asymmetry by valuing firms based on global earnings potential rather than domestic employment or wage growth. Stock prices rose even as local labor markets stagnated, reinforcing the perception that ownership of globally exposed assets mattered more than participation in productive work. At the same time, global savings flowed into financial assets, further inflating prices and rewarding those already positioned within capital markets. Governments often supported this process by prioritizing competitiveness, investment flows, and market access over labor protections, believing that growth would eventually benefit workers indirectly. Instead, the gains concentrated in asset values, executive compensation, and financial returns, while wage growth lagged behind productivity and cost of living increases. Over time, globalization helped cement a system where economic success was increasingly detached from local labor contribution and increasingly tied to ownership of scalable mobile assets. But globalization alone did not create today's extreme imbalance, because the most powerful accelerant came from the expansion of debt and credit throughout the system. The expansion of debt and credit acted as the most powerful accelerant in shifting capitalism toward rewarding assets over work, because it amplified the value of ownership while weakening the role of income earned through labor. As financial systems liberalized, credit became easier and cheaper to access, allowing households, corporations, and governments to borrow on an unprecedented scale. This expansion fundamentally changed how returns were generated. Assets respond immediately to credit conditions, rising when borrowing costs fall and liquidity increases, while wages adjust slowly and remain constrained by productivity, bargaining power, and labor market institutions. As a result, periods of aggressive credit expansion disproportionately benefited asset owners through higher stock prices, real estate values, and financial returns, even when underlying economic growth was modest. Debt allowed future income to be pulled forward, inflating asset prices without requiring corresponding increases in real output or wages. Corporations increasingly used borrowed money to buy back shares, acquire competitors, or invest in financial engineering rather than expanding productive capacity, further boosting asset values while limiting job and wage growth. Households were encouraged to participate in this system by taking on debt to access appreciating assets, particularly housing, shifting risk onto individuals while reinforcing price inflation. Governments supported this model by stabilizing financial markets during downturns, signaling that asset prices would be protected to preserve economic confidence. Over time, this created a feedback loop where rising asset values justified more borrowing, and more borrowing pushed asset prices even higher. Labor, by contrast, became increasingly disconnected from growth outcomes, as income growth lagged behind asset appreciation and debt obligations absorbed a growing share of earnings. Once debt-driven asset inflation became central to economic stability, capitalism's reward structure tilted decisively toward ownership rather than work. When debt inflated assets faster than incomes, the next transformation was how inequality became embedded into the system itself rather than treated as a temporary side effect. As asset values accelerated faster than wages, inequality stopped being a temporary outcome of economic cycles and became a permanent structural feature of modern capitalism. Ownership of appreciating assets increasingly determined financial security, while dependence on labor income alone exposed households to stagnation and rising costs. This shift created compounding advantages for asset holders because gains from rising prices could be reinvested, leveraged, and passed across generations, while workers faced limited opportunities to accumulate wealth without taking on significant debt. Financial markets reinforce this divide by rewarding companies and investors who maximize shareholder value rather than long-term employment or wage growth. At the same time, policy frameworks often treated rising asset prices as a sign of economic success, even when living standards for workers failed to improve. Housing, stocks, and other assets became central to retirement planning and social stability, making governments reluctant to allow price corrections that would harm owners, even as affordability deteriorated for non-owners. Over time, this dynamic locked inequality into balance sheets rather than income statements, meaning disparities persisted regardless of economic growth rates. Labor markets continued to function, but work alone became insufficient to keep pace with an economy increasingly driven by financial returns. This structural inequality reshaped social mobility, reduced economic resilience, and increased dependence on debt as households attempted to bridge the gap between incomes and rising asset costs. Capitalism did not stop rewarding work entirely, but it increasingly rewarded ownership far more, creating a system where economic outcomes were determined less by effort or productivity and more by access to assets. Once inequality became embedded into the system, its effects began to reshape not only wealth distribution, but also economic behavior and growth itself. As inequality became structurally embedded, it began to change how the economy itself behaved, not just how wealth was distributed. When a growing share of income and wealth flows to asset owners, spending patterns shift away from broad consumption toward investment, speculation, and asset accumulation. High-income households and institutions save more of each additional dollar they earn, directing capital into financial markets rather than goods and services produced by labor. This weakens demand growth in the real economy, making it harder for businesses to justify wage increases or productive investment, which further suppresses labor income. To compensate, the system increasingly relies on credit to sustain consumption, allowing households to borrow against future income or rising asset values. This reinforces the asset-based model because credit expansion once again inflates prices while leaving underlying income growth behind. Governments respond by supporting asset markets to maintain confidence, since falling prices would threaten consumption, pensions, and financial stability. Over time, growth becomes less self-sustaining and more dependent on intervention, liquidity, and confidence management. Work continues to generate output, but its role in driving growth diminishes as financial dynamics dominate economic outcomes. This explains why modern economies can experience rising GDP and booming markets alongside stagnant wages and declining living standards for large segments of the population. Capitalism begins to function less like a system that rewards productive contribution and more like one that preserves and amplifies existing wealth. When growth depends on protecting assets rather than expanding opportunity, the next question is how the system shapes political choices and public policy. As capitalism increasingly rewards assets over work, political decision-making begins to reflect this shift in subtle but powerful ways. When economic stability depends on asset prices, governments face strong incentives to design policies that protect ownership rather than expand labor income. Market downturns trigger rapid intervention through monetary easing, fiscal stimulus, or regulatory relief, because falling asset values threaten pensions, public finances, and household balance sheets tied to housing and investments. By contrast, wage stagnation and job insecurity tend to receive slower, more limited responses, as their effects are diffuse and unfold over longer periods. This imbalance reshapes public policy priorities, encouraging governments to focus on financial stability, investor confidence, and market performance as proxies for economic health. Over time, political risk becomes increasingly aligned with asset volatility rather than labor conditions, reinforcing a feedback loop where ownership interests carry disproportionate influence. Electoral outcomes, lobbying power, and media narratives increasingly reflect the concerns of asset holders, while policies that might redistribute gains toward labor are framed as risky or destabilizing. This does not require deliberate favoritism. It emerges naturally from a system where asset markets have become central to growth, employment, and public revenue. As a result, capitalism's institutional framework evolves to preserve asset values, even when doing so deepens inequality or constrains opportunity. Work remains essential to production, but its political leverage declines as economic outcomes become more tightly linked to capital preservation. When political systems begin to prioritize asset stability over labor opportunity, the long-term consequences extend beyond economics and start reshaping social cohesion itself. As asset-centered capitalism reshapes political priorities, it also alters social cohesion by changing how people perceive fairness, opportunity, and the value of work itself. When ownership determines outcomes more than effort, trust in economic institutions begins to erode, especially among those who rely primarily on labor income. Younger generations face higher barriers to asset accumulation, while older or wealthier cohorts benefit from appreciation they did not directly produce, deepening generational and social divides. This gap affects behavior in subtle ways, as individuals become more risk-averse, delay major life decisions, or disengage from traditional pathways of advancement that no longer deliver expected rewards. Work still consumes time and effort, but its diminishing ability to secure stability weakens its social legitimacy, leading to frustration, disengagement, and declining morale. Communities feel this strain as mobility slows, inequality becomes more visible, and economic success appears increasingly inherited rather than earned. Governments attempt to manage these tensions through targeted subsidies, tax credits, or symbolic reforms, but such measures often treat symptoms rather than causes, leaving underlying structures intact. Over time, social narratives shift away from shared progress toward zero-sum competition for access to assets, intensifying polarization and reducing tolerance for economic shocks. The system continues to function, but it does so with lower trust, higher anxiety, and reduced resilience, making societies more vulnerable to instability during downturns. Capitalism remains productive, yet its social foundation weakens as fewer people believe effort alone can secure a decent future. When social trust erodes alongside economic opportunity, the final question becomes whether the system can adapt without a major disruption. As trust in the system weakens, capitalism's ability to adapt without disruption becomes increasingly uncertain. Because systems that rely on confidence cannot function smoothly when large portions of society feel excluded from progress. When work no longer delivers stability or upward mobility, people begin questioning not just policies, but the legitimacy of the economic model itself. This skepticism manifests in rising political polarization, resistance to globalization, distrust of institutions, and growing support for radical reforms that promise to rebalance rewards. Economically, this loss of trust reduces risk-taking in productive activities, as individuals and businesses become more focused on protecting what they have rather than investing in long-term growth. Capital continues to flow into assets perceived as safe or scarce, reinforcing the very dynamics that cause the imbalance, while innovation and productivity growth remain subdued. Governments, caught between preserving stability and addressing dissatisfaction, often respond with temporary fixes that ease pressure without altering incentives, further postponing adjustment. Over time, this creates a fragile equilibrium where the system survives through intervention rather than organic strength. History suggests that such arrangements rarely persist indefinitely. They either evolve through deliberate reform or are reshaped by crisis when accumulated tensions exceed the system's capacity to absorb them. In this context, the danger is not sudden collapse, but prolonged stagnation combined with recurring shocks, as the economy struggles to reconcile asset-driven rewards with the need for broad-based opportunity. With tensions building and options narrowing, the final step is to understand what meaningful change would actually require and why it remains so difficult to achieve. Meaningful change in a system that rewards assets over work requires confronting trade-offs that modern capitalism has spent decades avoiding. Rebalancing rewards toward labor would mean accepting slower asset price growth, reduced reliance on debt-fueled expansion, and policies that strengthen wages, productivity, and real investment rather than financial returns. It would require shifting incentives away from speculation and toward long-term value creation, reforming tax and regulatory systems that favor capital gains over income, and redesigning financial policy so that economic success is not measured primarily through market performance. These adjustments are difficult because they challenge powerful interests, threaten short-term stability, and risk exposing vulnerabilities that asset inflation has concealed. As a result, reform is often postponed in favor of preserving the existing structure, even as dissatisfaction grows. History shows that economic systems eventually change when their reward mechanisms no longer align with social expectations or sustainable growth. That change can occur gradually through deliberate reform or abruptly through crisis that forces restructuring. Capitalism does not need to abandon markets or ownership to function, but it does need to restore a balance where work once again provides a reliable path to security and advancement. Understanding why assets came to dominate rewards is the first step toward recognizing why so many people feel left behind and why the system feels increasingly unstable. Whether societies choose to adapt intentionally or wait for disruption will determine how painful that transition becomes. If you want to understand how assets work, debt and policy shape modern capitalism, follow this series and watch the next videos where we break down the structural forces behind today, economic tensions, and what they mean for your future.